3 p.m. sharp. And we're here to talk about one of the most important strategy in taxes for your tax planning plot. We call that plot because that word has been used on the internet a lot. Assassinating plot and conspiracy theory plot. There's just a lot of things like that. But what we are doing right here is very straightforward. And what we want to demonstrate to you today is why you should do tax planning. Every time you think of planning, it's like paper talk, right? Come on, and don't have time for plan. I'm just gonna face the reality when it comes. That cost a lot. I'll just tell you, not 15 years ago, not 20 years ago, not last week, just this past 2 days, let me tell you 2 examples. People could have done planning, save a lot of money, they didn't, and they just went with the flow, and this has happened to them. So I have one client, new client, and he just sold his business not too long ago, 2 years ago, and paid $2.5 million taxes. When I look at this whole deal, if with the plan, I will tell you, guess how much she would pay if she planned. She would pay 0. Yes, she would pay 0. And she completely missed it and it did not do it and paid $2.5 million tax and is still paying even though she sold 2 years ago. So that's one example. This just happened about 48 hours ago. And what I realized, I'm not even sure and there is any save to that. It's just probably water under the bridge. It is what it is. But of course, it can be very different if you plan. Then second example, we have a person and with these taxes that he has done and all of the, coming in because he needs to pay $340,000 taxes. And he's coming in, he has no money. He felt he doesn't understand why he didn't have money and he ended up paying $340,000 taxes. We took a look at it and we didn't even do too much of advanced planning. We just explained how this works. And with that, and then he pays, guess what? 0 taxes. Folks, there's a big difference between you know it or you don't know it, you plan it or you don't plan it. I am saying that to you not only to brag, we are so good, but also to tell you that the opportunity is limitless. It's there. And you need to seek for your opportunity to get your tax really efficient. And we don't mind to pay taxes. When we make good business, you pay taxes, that's our duties. And that is something called responsibility as a citizen, as a business owner of this country, right? But you also don't want to overpaying taxes to the point that you're going to shut down and you're going to declare bankruptcy because you're not managing your cash flow properly. Overpaying taxes is not a issue of how much you respect the IRS or you don't respect the IRS. It has nothing to do with respect. Overpaying taxes, it simply says you are not an efficient business person and you are wasting your cash flow for a purpose that could help you to grow more instead, and you donate it out. And IRS don't give a word for people to pay taxes that they shouldn't pay. And the IRS also laugh at you when you do that because they didn't expect people to do that. But there's a lot of our folks are doing that. So today, and I draw back your attention, and we're talking about how we do tax planning here at Community CPA. So you understand the big picture, you hear what I'm saying, hopefully something along the line and trigger you to think that, oh wow, I did not think about that. So let's check it out. You can check it out with your own CPA. You can check it out with us. So the purpose is that we teach you, you learn, and you go ahead, do something good for yourself. Good deal? All right, let's get going. You are looking at our YouTube channel. Whatever webinars we're doing here, At the end of the day, it is all on the YouTube channel. And you can see there, you can click that magnified glass, and then you can type in what you want to look for. Then that's how you're going to find more videos. We have more than 1,200 videos in here. It's all related to taxes. We don't waste time. We just want to give you what we know quickly, clearly, simply, so you get it. And we also have this website. Let me find my mouse. I can't find my mouse. Can you click the website for me, Grace? So the website is where you can engage our service. But Grace, I don't see the website to show up, just so you know. Nothing shows up right now. Okay, so that's our website. This is where you can actually make appointment with us, right? You click the appointment button, you actually see me here. If you come over to make appointment with me, you know what time I have available, so you can book that. And of course, there's other partners here, and all of the people you see listed here are partners. So they are all specialized in different areas, so you can pick and choose, see who is the one that you need to meet. So with that said, let's go back to our plan topic, and I want to give you some graphics, some chart, a example to just kind of open up your eyes, so you kind of see, oh, that's what Ying means by tax planning. There is a very famous term we use in our firm. It's called a three-dimensional tax planning, and that reference to just one way to do tax planning. A lot of times, you know that when you go to your tax preparer, and you made a lot of money in 1 year, so your tax preparer will suggest that should you be buying a car, should you be doing this, should you be doing that. All of the suggestion is about you spending money. Am I right? A lot of times, our taxpayer don't need to spend any more money. They have the car, they have the equipment, they don't need to spend. But when you are only looking at spending money so you save taxes, it's such a piddly saving, because for every $100 you spend, yes, you save maximum 37%, and then what does that do? You still spend, 63%, that cash flow is gone. So is there any way to save taxes, but also do not causing cash flow shortfalls? The answer is yes. So let's look into that. The first two slides we have here is about our firm, and I just want to mention to you that we have 5 branches, and the newest one is Houston, Texas, opened up in July of 2024. And I myself served on the National Taxpayer Advocacy Panel for 3 years. So this is a panel of people provide advices to IRS. So it's a quite active panel, and their IRS constantly seeking for advices from people who are on the field. And so this is a active organization that trying to make sure that IRS is actually realistic and practical and meeting the taxpayers' expectation. I also wrote 2 books so far, 8 a.m. and 10 a.m. So these 2 books are on Amazon. If you're interested, I know the content I talk about today is in the 8 a.m. book partially, because you are starting up a business. So I was introducing to you about the structures, how that related to the taxes is reflected in that book and mingled with a story. So I try to introduce the knowledge to folks that with a real life story. And actually, in terms of this example I'm going to use here, later on you will see, is also not a fake story. It's not a fake imaginary things. It literally happens every day. So you will see how important that is to know what you should do when you file your taxes. And tax planning season is the last quarter of each year. So you plan your 2024 between your October and December. a lot of things, if you wait until December is over, arriving at 2025, filing 2024 tax return, you say, well, I want planning. A lot of things are too late. A lot of things are too late. So you want to do it while you are still in the year. Now, no responsibility disclaimer, really important because we want you to take responsibility of what you learned here. We don't want you to blindly follow things on the internet because you know what kind of quality of videos are out there. And one time I heard someone saying that he was looking for a video that explains ERC claims at that time. And he gone through so many videos and finally come across ours. And the comments I got from this gentleman, and now is our client, he is saying that everybody was there saying things just doesn't even make sense. And some are absolutely wrong. I even know they're wrong. But when I come to your video, I knew that this is the quality videos that everything you said here is really helped me, and I followed the guidance to go forward. So that tells you that we do a really good job at vetting through our content. We have senior partners here actually looking at the content, making sure what we're talking about is actually correct. And then we also have folks like Catherine is really the librarian and the marketing person and knows what you need and go through research and coming up with the initial content reviewed by senior partners, then come out online and I talk about it. So I'm not going to take all the credit. Not every time everything is mine, but this particular tax planning stuff, it is something that I initially created, wrapped around the concept, trying to make it simple for folks to understand. If I make it too codey with all kind of codes in there, it will just bore you, and you don't want to hear that. You want me to talk in Chinglish and give you the real content that you need to know. So, how we do tax planning, and so the tax planning. It is a process we conduct at the last quarter of the year. We only do planning for the year we are in. Once you are passing this year, the planning is really not planning anymore. It is damage control. So what we do is we do that in the fourth quarter of the year. So right now is the time. And we use these tools. We use the planning tools to save your taxes and plan for the future years. When I say future years, I will never plan for 10 years, 20 years, like what financial planner, our wealth division would do. Tax planning is for today, and especially strong today because tomorrow the election will come through and the new leadership in the White House would have a different approach to taxes. So you never know what kind of things would pass by Congress, right? But taxes is something that has to be agreed by both House and Senate. Then the Congress will pass that as a law. So the president doesn't really have the magic power to just make it happen. He can force through the Senate and the House, come up with a proposal, and he can sign into the law. But in the end, tax is still a group decisions, those we elected at local level. Your Congress people and your senators, those are the people voting for these tax rules and regulations and all the incentives and stuff. So you really don't know what you are up against. And we are just at the too lower level to really decide what's going to happen at White House or at the Capitol. So with that said, tax planning doesn't go very long. We just plan for right now. The most we do it next year. But you will hear me talking about next year because next year we don't know a lot of things about next year. So now I'll come back to what I said. Our concept of tax planning is not to spend money, period. You don't need to buy a new truck. You don't need to buy equipment you don't need. You just need to know that there is a three-dimensional planning that you can utilize. I drew this picture for everyone, everywhere I go. When I talk about three-dimensional planning for companies, everyone understands what I'm talking about. But you just have to understand that is a one object, and the three things can come in. So one company, you can consider fiscal year, you can consider accounting method, you can consider the tax structure. That's why it is a three-dimensional work. It is not about, oh, go spend more money. I mean, how much money can you spend? I don't even, yeah, you can spend a lot of money, but when you don't need it in business, you don't want to. You want to accumulate the wealth, right? So you want to utilize our wealth divisions at Community CPA. So here, this is a map that I'm just going to quickly show you. And if you ever wanted to see this again, you can go through our webinars and you will see that on the screen. You can snap a picture out of it. But what I want to give you right here is just a general tax structure that we use today. And for example, that dotted line right in the middle, you see above that, those are the entity that we call them pass-through entities. They all landed on your 1040, right? You can see this on this right-hand side. There is a 1040, and your multi-member LLC pass through to 1040. Your S corp can go to 1040 because they don't individually pay taxes at the federal level, correct? And then inside of 1040, you can have your sole proprietorship, you can have your single member LLC. However you operate is one tax return, and you don't need to pay fees for doing another tax return. They are all here. But underneath that dotted line is your C Corp and your nonprofit. And nonprofit organization, more and more people are setting up their own nonprofit organization, right? Like Sandy Hook victim, they have this nonprofit against gun violence. So they have this new nonprofit. And you can also, for good purposes, to have your own nonprofit set up as well. And I just had a client came to me, said that, her attorney said that she cannot set up the nonprofit for her own purpose because it is too self-serving. So I guess what we need to understand is that when you set up this nonprofit and you are directing your money to nonprofit to serve the public. But when you're directing money from you to the nonprofit, we don't call that self-serving, even though you can reduce taxes. I call that that's a good heart donation. That's you have that good thinking, the welfare for the community. So you take your business profit and you donate to the nonprofit you established, and that one is served to a general public. So for a purpose, you can, for Sandy Hook victims, and they set up the nonprofit to work on gun violence prevention, and you see their ads all over the place. So I think they're pretty effective. So with what you want to do, and you can do that as well. So it's not self-serving. I don't think the comments was even appropriate. As long as your nonprofit is being approved by IRS, and you should be fine, and you are serving the general public. If it is a narrow group of people, obviously you can have foundation, obviously you can have association. That is a different type of nonprofit, but it is still a nonprofit, right? So C Corp as well is a private, closely held entity, and you can have your business under C Corp. So this is a chart that just gives you the overview of what is related to the 1040, what is passing through, what is separated from the 1040. You see that only W-2 1099 dividend can go up to the 1040 from C Corp and nonprofit. So they're really independent from your pass-through entities, right? The LLCs and the S Corps. So now let's just quickly understand the three-dimensional and accounting method. We all know what is accounting method, right? Cash method, accrue method, hybrid, mark-to-market, and for inventory there's accounting method as well, first in, first out. So all of these accounting method is actually a way IRS want to know how you calculate your profit. IRS want to know that if you're cash method, IRS understand when you receive the money is your income. when you pay money out, it goes out of your bank account. Truly went out of your bank account, that's your expense. So if you're on accrual, IRS understand, and you have receivables, you have payables. So those are the accounting method has a big impact on your taxable income calculation. For example, we have, some times ago, we have a training institution coming to us, and they actually charge, they're extra curriculum training, so they're not the credit school. So what happened is they train for 9 months. So they always open school in July or in January. So you can imagine from January to September, so they charge the tuition in January, but they did not provide service yet until each month is over, right? So you can collect $9,000 for 9 months, but in January, your revenue recognition and your accrued accounting method should say that you got $1,000, right? Because that is that's what income you really received. The rest of the income, you just, is your liability, is not even your income. So these method, those thinking of how you are generating the revenue has a big impact on how much you're paying taxes. Of course, January to September, it doesn't really matter because it's in one calendar year. Assume your business is open from January to December. But what about July to December one? Because you don't finish teaching until March, and then you got 3 months belongs to next year, so those you should not be paying income tax on it, right? So then what about for the expenses? If your accrual method and you bought the machine, it's already running for you, but you still have time to pay because the manufacturer gave you 60 days to pay. If you're on accrual, you can deduct that machine already because you're already using it, you're already producing it, but your payment is still pending. That's your payable. So with that said, just give you a concept, and when you feel like, whoa, I have a lot of taxes to pay, but I don't have money, maybe the income you haven't really got it, but you already reported as income. So that could be one of the reasons. Then you want to look at which method is working for you the best in your industry, right? So, to quickly say that for dental offices, we always say that you have to be on cash. And for supermarket stores, we say that you should be on accrual. And then you may wonder why? And, I don't have time right now to tell you the details why, but just to say that, you see, different business has a different accounting method. You need to choose that carefully and mindfully. Calendar year. And if your business makes money on the last day of December, and you make your fiscal year last day of December, that means most of the income you're getting, you're going to face paying taxes right away. But what if your December month is the only month that you are making money, then I would make your December 1st to be your year beginning, so you have the rest of the 11 months to spend. So that is the difference between calendar year and a fiscal year. And you want to make sure that you evaluate your business. So there are rules, right? There are rules. IRS says that you can change your calendar year to fiscal year, and if you have 2 months consecutively making the income that is greater than 25% of total gross sales. So you follow those rules and determine whether you should be actually having a fiscal year instead of calendar year. So those are things, folks, we don't consider enough, because when you got your passionate heart to form a business, to get going with your business, and these are the last topic nobody even talked to you about until you come over to the CPA firm, goes, oh, I want to do my taxes. Then everything is come out. It just doesn't even make sense. We have folks who did business just for 1 month. So he formed a company, and starting from December, made money 1 month. So he come over to do taxes. And so much income, and there's not a lot of things can be deducted. And why are you not making your 1 month, the beginning of the year, for your company? You don't even have to come to do taxes. Goodbye, and see you later. So those are the things, you got to have this 3-dimensional thinking when you are in business. Think about your accounting method. Think about your tax calendar, the calendar years or fiscal years, and think about what? Tax structure. So tax structure, we talk about that a lot, right? Earlier, I already mentioned to you about those structure. Every structure serves different purposes, and I do want you to know that that's also a knowledge that you need to acquire. And if you go onto our YouTube channel, you just type into tax structure, you'll find a lot of YouTube videos that we already have for you. So now I want to work an example with you. Jim and Molly. Jim and Molly file joint return. Jim and Molly has a partnership called AAA LLC. And this partnership, what they're doing is they actually they're producing in this example, it's actually a general example, but I'll just give a content to it. It's a restaurant. How about that? It's a restaurant, owns the restaurant building, owns the restaurant operation, and also does the supplies packaging, sauce packaging. So it's a AAA LLC. So the husband and wife and the work on that business. And so this is the tax chart that we have, our firm we use. So we don't go out to buy these some formulas, some templates. So when they print out your tax planning, they print out 58 pages. No. In our firm, we do tax planning. Our whole purpose is that to shrink your very complex situation into one page. If we can give you one page, you walk home, that is our success. Our success is not to give you a book, so you never learn, you never read, and you just felt like, oh yeah, Ying charged me money and this is worth it. No. And I charge you money still, but you will get one page. That is how we do business here. So look at this chart, folks. And you got 2 boxes. That means you got 2 tax returns. That's how our chart goes. Every box means every tax return. So this box has this 1065 cash method, and it got this gross sales of 887, and the total deduction 646. So for $240,000 left. And this one got 50-50, went to husband and wife's tax return on 1040. Folks, did you notice that $240,000 that paid taxes, and at the end that is the federal taxes of $58,000, and the state taxes we just use my home state, Iowa, and $8,226. So this is the total taxes Jim and Molly will pay. If they run this successful business, they made money, they're like, oh wow, we made money, we have $240,000 left, we pay these taxes. Nothing wrong, and Jim and Molly can continue to do that, but I do have some comments. So here, this is the word version of that chart. So you can see that the estimated profit is 240. So we have these taxes calculated. One comment is that this 24% is based on the income, right? If they make $400,000 K net profit, they will be paying 37%. But this is 24 is their real rate. We call that effective rate. Then you have a self-employment tax rate that's about 15%. So with this two rate, the tax rate 24% is higher than the C Corp tax rate of 21% today. I want you to take a note of that because the C Corp rate is a flat rate, 21%. There is a rumor, I don't know, is really a proposal yet, but there's talk about this rate could change. So that's why I tell you there's no need to do tax planning for next 10 years. So if someone come over to tell you that, let's pay taxes right now, so 20 years later you don't have to pay taxes, wouldn't that be a good deal? People who give you the Roth IRA say that to you. They're saying that pay taxes right now because when you get older, you don't need to pay taxes. You take all the money for free. I don't buy that. I do not think that's right. I think the financial planner doesn't understand taxes either. Tax is changing every year. When you are older, which maybe means 20, 30 years later, and who knows what our tax system is going to be. Maybe there's already new tax law to say that seniors over 65 years old would not pay taxes, period, until they die. All right? So don't really buy things. Don't do anything for taxes for 20 years later. No. If someone tell you that you do this so you can save taxes 20 years later, ignore that comment. It's just not even relevant. So I only do that for this year, next year. And maybe 4 years if the presidency is stable. And if presidency, the White House residence is not stable, then I only plan for next year. So that's just how the reality is at the United States of America. Right? So self-employment tax for 1065 is applied to every dollar you make. If you are check yourself as a general partner, an active partner, and then you actually pay self-employment tax, which is right here. So now, related to Jim and Molly, and what are the tax tools I would have, knowing that he owns the building, he runs the restaurant, and he also sells the sauces that he made. Okay, with that said, I think of C Corporation, 21% flat rate. And I think of S Corporation to run the restaurant business itself. I think about the 401k that he should give to himself and the cash balance plan, the retirement side of things. Then I also think of maybe he need to purchase anything new or not. This is the spending part, right? I think about that. And of course, I also know that Jim and Molly are very given. They already give all their leftovers to the local church and every Sunday morning, and that's what they do. They haul out their food and they give to the church for the Sunday service. So then R&D, so these sauces they're doing actually was very complex, and they have this secret package. Then you can make this dish without any variance. So like if you call this dish ABC, and then you use this sauce, and no matter who cooked this dish, it's gonna be ABC. So those are the things I am thinking. And I'm thinking about cost segregation, just because they have a building and I want to know how they depreciate their building, right? And then health insurance premium deduction. Those are the things run through my head, and I'm thinking, okay, I need to look at how that would work. So now, with that, Jim and Molly came back and they said that, okay, Ying, and we just started this, and this is the first year, and we want to know whether this is all fitting for us. If we're gonna pay almost $70,000 taxes, and is there a way you can do and to make that less? So let's see what we can do. So we want to form a C corporation called a BBB Inc. And we also want to have this BBB Inc. Fiscal year ends in November. So we want that to be on accrual basis, and we say that the BBB Inc. is a service provider to AAA LLC. So this is kind of the definition I have. So BBB Inc., you can imagine that this is the company that producing the sauces, and it is providing that sauces to AA LLC because that's their restaurant, right? Now, and we also say that, okay, we're gonna form a S corporation. We call that CCC Inc. and is providing service, is a service provider to AAA Inc. again. So the CCC S corporation is what? That is a operating company. It doesn't hold any asset. It's just running the business. It's gonna run W-2. It's gonna build 401k. It's gonna build cash flow, cash balance plan. It is going to build health insurance for the people who works in the S corporation. Now, what other tax strategy we would have? We would have, we think of purchasing new equipment. That's the spending. We also think of how Jim and Molly can donate money to nonprofit, or even set up their own nonprofit if their specialty, if their accomplishment, goals and the mission visions is different from the nonprofit that around them, right? And we want to look into R&D, and we want to look at their property to see whether cost segregation can be done if it is already, if the building wasn't purchased in 2024, then we want to see whether there is any reason to make changes to that depreciation. Use Section 481A. with that, and we look at the insurance. Oh, by the way, if we set up 401k and stuff, we can apply for the $5,000 tax credit that given to the businesses who set up the retirement plan for the first 3 years. So there is more talk about the employer side of benefit for setting up those plans for the employee. So now, with the tax planning, the partnership AAA LLC has a profit of $4K, and the C Corp BBB has a profit of $58K, and then S Corp CCC Inc. has a profit of $28K after running W-2, 401K, and the health insurance deduction. So I want to show you this map. Then this is the old map, right? So Jim and Molly are just running everything under 1065 partnership, and they combined all of their revenues into 887. So essentially what we're doing here is to split out the profit they have, the sales they have, into different nature of business, because some of these earning they have maybe rent, some of these earning they have maybe selling, the restaurant selling for sales. Then the others selling, maybe different selling for different things, right? So I basically break down that sales, right? So look at this new map, and we have this cash method 1065 AAA. That is how much they make, how much they expensed out. So here you have a profit. And then you have a CCC, that is S corporation, is passed through. So we have this green arrow goes to 1040, and you pass through on the income. So right here, you already realize if you just add the sales up on this 186 plus 427 plus 273, in a way, it is what your total running is as you as a business owner. But you are splitting them up into a different reasonable entities. They have reasonable meanings. They're separated. They're not the same. A lot of our people knows that if you have a building, you run restaurant inside, you want to put your building outside as a LLC, then you run your business as a S corporation. That's a lot of irregular setup. Am I right? But now we have another setup here is a C Corp fiscal year. So whatever we know that we will pay, we can even make the C Corp understand that this C Corp is making money, and on its own is $273,000. It makes the money, and with expenses is $58,000. So look at the red color on this screen. The red color means how much money and the Jim and Molly's is going to pay on tax side. So if I give you a word summary on this one, then you will see that before we pay $66,642, because that $58,000 includes income tax plus self-employment tax, remember? And then you got the state taxes, and here you go. But after we break down the business and then putting in different structure, having it all coming up to be all organized, and with the 3D thinking that we had in the beginning, then you clearly see that the federal taxes for 1040 is $9,000. Then 1040 has a $3,000 state taxes, and then your 1040, then your 1120, that this separate entity right here pays taxes as well. So it has the $12,000, $3,000. So your total tax due is what? Is $28,000. Isn't that almost? Isn't that more than 50% of saving? It's $38,110 difference between what you would pay before, what you pay after. So did this whole thing have complications? Of course, you need a taxpayer to understand why, what was the business reason to actually separating them that way. You got to have a business reason to do that. But the business reason is literally called experiences. Is someone with a business experience understand which part of business should be carved out, which part of business should stay in, and the one stays in, what needs to happen based on the tax structure. It is all different when it comes to how to split it up. Of course, IRS will not want you to do the split if you just don't even have a business reason, or the only reason is I don't know why I do that, I just know I pay less taxes, that doesn't pass IRS's auditor. And what you need to know is you know the business reason, then you apply the most effective tax structure, the most effective accounting method, the most effective calendar year, fiscal year cut. The year end, where you cut the year end. All right, so with that said, and I want to let you know that we do, as a Community CPA, we provide tax planning service. And you can book our time to come in to initiate the process, but typically this is how we do it. If you come to us, you never file taxes with us, but you got this whole business things and you want us to look at it, to do the planning for you, we want you to bring all your prior year tax returns over to us. And once we have your prior year tax return, we actually charted you out for the original map. So we will tell you this is what you have. This is exactly what we did for the $340,000 tax saving for that one taxpayer. And they have, if I remember right, they have about 3 pass-through and a 1040, and then the other are the other side is one of the C corporation. So they have this structure already. But the thing is that in their return, they actually did not utilize the bonus depreciation, Section 179, all of the related tools that inside of our planning. So a lot of tools I did not really specifically mention to you just because they're endless. And there are some of the tools you have to read interpretations from Journal of Accountancy, and that's where we get a lot of our information. And you need to look to see how people use it, right? So how the Journal of Accountancy or how IRS interpret how to use these rules. So those are the things that will come through when you do tax planning. But we charge you as you are today, and then we will start implementing what we think is appropriate. Those implementations need to be done in the same year. This is why I say the planning need to be done on the 4th quarter of the year. You already sense the urgency. You already know you are making a bunch of money, or you already knew you're going to lose a lot of money, but you don't know whether that can help you to do what, to the future, to the past, and you have that question. That is where you needed the planning, right? So don't forget, and to book our time and to call the office. And I know on this slide you didn't have Houston, Texas, but we do have Houston, Texas office. It's already operating. We have people in the office, on the office hours, so you can definitely get to us by calling our office number. Our office number is 515-288-3188. You call that number, and we open Monday to Saturday. We are the only CPA firm in this country open 6 days a week regularly. It's not because now is what we open. No, we open 6 days a week regularly. And again, this is the partners you have, and you can book our time. And the email, if you have questions or you want to hear more of the subject that you care about and we did not talk about in the past, please email Catherine at communitycpa.com. And this is our phone number, 515-288-3188, folks. And give us a call 6 days a week. And we would love to see you getting on the wagon of planning your taxes. That's the only way, and you can be a efficient, smart, and a cash flow sensitive business owner. That's the only way we can succeed.